Dmitry, it's no surprise that the global pandemic has resulted in elevated volatility. What's been your response and how are you positioning going forward?
Yeah, so volatility creates opportunities as scary as it might be in the short term. And I think I'm probably going to butcher Buffett's quote, but he said you're going to be fearful when everybody's greedy and greedy when everybody's fearful, or something along those lines. So what we've done in our portfolio over the last couple of years is tighten up, get rid of low conviction ideas, reduce the number of holdings, and double down on quality, with an idea that the expansion market being long in its tooth, we're deemed for some kind of a downturn. Nobody could have predicted COVID pandemic globally, but it's always gives us comfort to own this high quality franchises that can compound value over time, and that's the way we approach investment world. Is that we don't start with valuations, looking for cheap stocks. We really start with the business model, the franchise characteristics that we're looking for, the durability of the cash flows, the stability of their position within the market that they operate, and then we try to buy them at attractive prices. Speaking of which, the period of sell-off earlier this year created plenty of opportunities for us to capitalize on companies that we've been looking at and aspiring from a side where valuations before the sell-off were not as compelling. With the market sell-off and the baby being thrown out with the bathwater, a lot of really high-quality businesses were selling at very, very attractive prices. So we've pulled the trigger on a bunch of them. Some of them include names like Lam Research, which is a technology company. They make semiconductor equipment, and it's effectively a 3 or 4 companies globally that control market, very high barriers to entry, a very well capitalized company with no net debt and strong free cash flow. And we were able to buy during the sell-off at a very reasonable multiple of sort of low to mid teens. And there's a few more examples of that. So volatility is unsettling, but it creates opportunities. And because we are long-term buy and hold investors, we take a 3, 5, sometimes 10-year view with an idea is that we want to buy these companies and own them for a very, very long period of time.
And in contrast to cruise lines and some of the cyclical areas that Matt mentioned, the technology sector has really been on fire as of lately. So Dmitry, as a value manager, are you finding opportunities there, or are valuations just too demanding?
It's a very fair question, especially in light of what we've been discussing, that technology not really being impacted nearly as much as some of the cyclical areas of the market by pandemic. But what we try to do at ClearBridge with large cap value strategy is that we try to buy defensible franchises at reasonable valuations. And what we've learned is, and we've made our mistakes, looking for cheap stocks within technology, and it's not always a good area to be hunting for value because it would end up being value traps. But what we look for is defensible businesses, and fortunately or not, technology has a lot of the areas that are defensible, where franchises have high barriers to entry, high moats around them. I mentioned Lam Research being one of them. We've owned probably for a good part of a decade companies like Motorola Solutions, OT connectivity, not necessarily household names that most investors know, but Motorola Solution, even though people know Motorola Solution, Motorola is a name, but it was a company that spin off the handset business. They're the company that created the first cell phone decades ago. And then they sold under the pressure of Carl Icahn, they sold the handset business, spin it off and sold it effectively to Google, which now makes Pixar based on that technology. But Motorola Solution remaining company is effectively a oligopoly, if not a monopoly, in a first responder sort of two-way radios. And it's a under the radar kind of low to mid single digit grower with stable margins, a lot of cash flow. And what they're doing is leveraging their relationship with local, fire chiefs and police departments and getting into the, call centers for 911, for example. That's a very segmented market. There's a lot of old technologies. It's not in the cloud, and they're just leveraging their cash flow to get into that business. It's not necessarily zero exposure to cyclicality, and it's obviously being funded by local budgets, but it's a name that we like and continue to own in pretty good size. T Connectivity is a company that makes connectors. It's a spin-off of old Tyco. We've owned it probably for about 10 years also. And the beauty of that business is that about 40% of the business is tied to automotive. Automotive is a very cyclical business. So when people stop driving, you can't go to the dealership to buy a car. Obviously, GM and Ford and other OEMs shut production. It hurts companies, suppliers like Tier Connectivity. But the beauty of that business is that it generates cash through all parts of the cycle. And electric vehicle is a huge tailwind for the company, because the content per vehicle goes from about $65 for internal combustion engine to roughly double that with higher margins. So we, in addition to owning companies that are sort of in the mainstream that you think about, there are others that give you sort of this defensible business models that may be flying under the radar that are very attractive franchises that we feel comfortable for a very long period, or owning comfortable for a very long period of time.
And the electric vehicle trend seems like it's here to stay. For example, with California trying to go carbon neutral by 2045.
That is very true. I mean, I think decarbonization is a trend that, for various reasons, makes a lot of sense. Different countries are taking a different path, even within the United States. California seems to be at the forefront of sort of environmental regulation. There are a lot of sort of startup companies that you can participate in that trend through. Being that we look for established sort of franchises, we look for opportunities where we can participate, but not necessarily bet the ranch of the entire company in that area. And the way we can play that is companies like TL, which I mentioned already. We own a couple of California utilities, Edison International and Sempra. And it's unfortunate and horrible that there are all these wildfires and people are dying and they're losing their properties. The fact of the matter is that they've created this wildfire fund that all utilities contribute into, and that should protect effectively, publicly traded utilities from being effectively going bankrupt, as long as they are found to be prudent in the way they run operations. But Edison International and Sempra, being over time, will be beneficiaries of this massive investments in renewable infrastructure, right? Because you need to deliver energy from the point of generation to the point of consumption. So we think of those two businesses as companies that should grow earnings at about 5, 7, 8%, that are trading at or below market multiple. And Edison International has some uncertainty about the liability related to prior fires, but nevertheless, it's more than priced into the stock. So those are some of the areas we participate in, sort of the green renewable energy. Then there's a couple of other companies we can cover.
Now, Dmitry, how are you monitoring the macroeconomic picture?
Well, we are bottom-up stock pickers, really. We are active managers. We're not trying to position portfolio for, bull market or bear market, for a V-shaped recovery or a K-shape or a W, whatever other letter people tend to use these days. We just try to buy, the best quality franchises we can at reasonable valuation. But I would echo what Matt and Wally said, that it's an external shock. Some people use an analogy of a hurricane in certain areas where they see that huge V and a very rapid sort of recovery. The massive fiscal and monetary stimulus that has been put in place over the last, call it, 6 to 9 months, is sort of trying to bridge the gap between, sort of pre-COVID world to the point where economy recovers to some extent and businesses start opening again and people start feeling comfortable getting on the planes and going to restaurants. And we, as a country, we've done a pretty good job doing that, but we're not there yet. And there's a lot of uncertainty with respect to whether the next stimulus bill is going to come in place or not, when it's going to come. And, obviously election is a huge swing factor. So we feel that people who try to make predictions about macroeconomic sort of outcomes are right about 50% of the time. It's only apparent when they're right, looking in the rearview mirror. We feel that it's hard enough to pick stocks, let alone predict what economy is going to do. And that's why it's even more important in this environment to focus on what we think we do best, which is, buy the best businesses we can at most reasonable valuations we can afford to pay.
Well, moving on to the investment process, Dmitry, how do you define your approach to value?
Yeah, so while I talked about sort of the history of CompuStat and dividing, lower half of, stocks by price to book, price to earnings as a shortcut for valuation. It works for some people. We feel that looking at evaluation as sort of as a primary way to sort of narrow the funnel of your investment universe or opportunity set is somewhat flawed because things change and they don't always revert to the mean, right? So the competitive dynamics change in the current environment. Technology, we covered technology at length already. Technology can be a disruptive force that kills a lot of businesses and creates a lot of new businesses. So it's somewhat dangerous, in our opinion, just to look at valuations and say the cheap stock is therefore a value stock. What we try to do is we try to find competitively advantaged businesses at reasonable valuation. And when we say competitively advantaged businesses, we look for companies that have resilient and durable business models. And it means that they have strong balance sheets and they have enough profitability to withstand the inevitable bumps in the road, whether they're macroeconomics or competitive or otherwise. And resilient means it's the company position within its end market and its stability of the end market. And it also means, how do we think about the risk of disintermediation or technological obsolescence? So it encompasses all those different factors. And then only after that, once we feel comfortable that the franchise really has those core characteristics, then we'll look at valuation. And we are very disciplined. We don't pick a point in time and say at 10 times or 15 times multiple, it's attractive. We'll look at things on a normalized basis. We'll normalize for the cyclicality of the business. We normalize for the balance sheet differences and a lot of different factors as well. And we try to really heavily discount sort of something that may or may not occur in the future. So we look at the cash flows at the short to medium term and products or services that are not in the market today and may or may not come to market anytime soon. We're not going to really bank on it. So, a good example of that would be if we look at a pharma company or biotech company, and we don't own a lot of them, but we own some, we're not necessarily going to bank on a phase 1 drug coming to market. We're going to do a DCF of existing products that are already in the market, and if the stock is below that value, then we'll try to buy it. And if it's not, then we're probably not going to buy it. And if there is a pipeline drug that happens to hit the market and is a great success, it's an icing on the cake. But we're not going to make a decision to buy a stock on a binary event like that.
Dmitry, can you give us an example or two of how you factor ESG into your research and your stock selection process?
Yeah, so ClearBridge has been an ESG investor for 20, 30 years, and it's changed what it means to be ESG investor today versus 10 or 20 years ago. It used to be SAR, sustainable investment. Now it's ESG. So the terms, the semantics change. But at the end of the day, what you're trying to do is you're trying to buy companies that are not only worrying about the bottom line, but they're trying to do the right thing for their employees, for all the constituencies, for their employees, for their customers, for their communities, and treat people the way they're supposed to be treated. And the approach that we take at with large cap value strategies by focusing on this, competitively advantaged businesses, the upside of that is that by being more profitable than most of their peers, you have plenty of firepower to not only deliver to the shareholders, but to deliver to all stakeholders. And a couple of examples to use is, let's say, Home Depot. It's a company we've owned for over 10 years now. And I do a fair amount of work around the house. I like to do, a little electrical work, a little carpentry, whatever. So, and there's a Home Depot and there's a Lowe's, and I'm not poo-pooing one at the expense of the other, but, it's striking how well Home Depot handled COVID, not only from the standpoint of making sure that customers are safe, right? They cut number of hours, they had people at the door clicking how many people come in. There are lines and footsteps everywhere to make sure that you keep 6 feet of distance in. They make sure that everybody who comes in wears a mask. They put protective sort of screens in front of the people who work behind cash registers. So, and they did it, and they pay extra sick leave, extra compensation to the employees on the floor, given the fact that they're taking risk by being interacting with their customers. So again, their profitability is materially better than most of their competitors. They can afford to do it. The other good example is Deere. Deere is a big agriculture and construction equipment company, right? If you live in a farmland like Wally does, green equipment is probably something we've all seen many times in the fields. Deere generates about 25 billion of revenue. About a third of the global ag market is Deere's. The next three competitors are slightly above that, so they have a scale advantage. They have 5,000 distributors globally. They have dominant share in US and Latin America. So what that affords them to do is that affords them to focus not only on making, heavy metal machines, but focus on precision agriculture. So the precision agriculture, it's a very heavily R&D focused area, requires a lot of software investments. And what it allows them to do is it allows them to reduce usage of water and harmful chemicals while improving the yield for the farmer. So it serves dual purpose. Helps the farmer, makes the bottom line. It helps the environment by reducing use of water and harmful chemicals. They made an acquisition a couple of years ago called Blue River. It makes basically cameras that are put on the bottom of the sprayer and planters. And the camera basically can, over time with AI, learn to differentiate between the crop you're trying to grow and the weeds that you're trying to kill. And it, instead of spraying sort of all around the area with pesticides or herbicides, you can effectively do it much more targeted, and you reduce, let's say for cotton crop, you reduce use of harmful chemicals by about 90%. And at the same time, you improve the yield for farmers by 10 to 15%. So that type of differentiation, so it's clearly ESG, jewel that serves multiple purposes, and it extends the competitive advantage of companies like Deere. But it's an integral part of the process. It's not something we outsource to third party. We have access to MSCI and Sustainalytics and all these other third party sources. But it's something that we rank all our companies, our analysts rank all our companies on ESG metrics. They differ from company to company or sector to sector. And we engage with companies on ESG matters the same way we engage with the companies on any other fundamental issues. It's a way to control risk. It's a way to control management intentions, and so on and so forth. So it's something we've been doing for a very long time, and it seems to be catching a lot of attention these days. But it's been ingrained in our sort of research and culture for many, many years.
And Dmitry, you're clearly an active manager at heart, doing some boots on the ground research at Home Depot for your home improvement projects. Why is active management important to your portfolio, and how do you think about the ways that you line up and don't line up with your benchmark?
Yeah, so look, I mean, there is a trend in favor of ETFs and index funds, and it's a trend that's above and beyond the control of anybody on this call, right? It's a mega trend that'll continue for as long as it does. We have no way of stopping it. We as active managers are not obviously big fans of that, but it's democratizing investments, right? Effectively, it allows an educated investor to participate in the market. in a broader market or narrower slices of the market, depending on the index you participate in. So it's cheap. And what you get for the cheapness is basically everything that Matt and Wally have mentioned already. You effectively get exposure to the market, you get beta. But by definition, you're not going to get alpha out of it, right? Because if the market is actively, if the index or ETF is actively following a particular type of the market or slice of the market, you're just going to get to keep up with it for a very inexpensive price. As active managers, what we're trying to do is we're trying to generate alpha, meaning outperform our benchmark. We're in a relative performance game. Our benchmark is Russell 1000 value, and we're trying to outperform the benchmark by making active bets. And by active bets, I mean we're not trying to look like an index. We're not trying to look like a ETF. We're trying to look different by making decisions to invest in areas where we feel will be able to generate outsized returns relative to our peers and relative to our benchmark. And it varies depending on what sector you're looking at. There are parts of the market where there is plenty of differentiation amongst companies that operate in that market. And those sectors include industrials, for example, includes communications, it includes materials even though we shy away from commodity chemicals, for example, there's plenty of companies that are differentiated enough. And those are the sectors that we feel very comfortable making, and technology, obviously. We spend a lot of time talking about technology. We're very comfortable making, pretty active bets in size. And for us, size means, position sizes, up to 5% probably, even though technically we can go higher, but we try to limit that at that level. And there are some other parts of the market which are more exposed to variables outside of our control. And those would include sectors like financials and energy. Those are driven by big macro variables like oil price, for example, for energy, or interest rates for financial sector. We don't pretend, as I mentioned, we're not macroeconomists. We don't bank on interest rates or inflation, as we discussed earlier, going up or down. And in those part of the market, we just try to have exposure so that if there is inflation, we participate in that inflation, the benefits of that inflation. But at the same time, we're not sacrificing the quality focus that we have at the core of our strategy. So whether we're talking about energy company or we're talking about money center bank like JP Morgan, we always try to buy best capitalized, best managed, least leveraged company. If it's an energy company, we're looking at the lowest cost resource base. If it's a bank, for example, we will look for deposit base that is a competitive advantage and diversified revenue stream. So that's the way we think about sort of broader positioning versus an active management versus our sort of benchmark.